Now, when I evaluate the economy right now, I see distress despite the stock market hitting all-time highs. Now, I look primarily at US debt, money printing, inflation to build my thinking, but I know you have a different take on what really drives the economy. So what signals do you look at? And when you look, do you see an economy in trouble right now?
Yeah, I mean, we've seen an economy that's been in trouble for quite some time, and it looks like it's resilient simply because of the fact it hasn't fallen off. We're given an either or. Either the economy collapses tomorrow or everything must be fine. And, like anything else in life, it's usually the truth is somewhere in the middle. So what I look at is I look at financial information. I get, look at, the yield curve is a good place to start, but there are many other curves that are just as helpful and just as insightful.
Now, somebody that doesn't know the yield curve, if that's where you start, give me like a quick primer on that.
The yield curve is nothing more than Treasury yields plotted in a line from shortest maturity to the longest maturity. And what you normally want to see in a generally healthy environment, or what's indicated to be a healthy environment, is an upward sloping curve. Not steeply upward sloping, but somewhat upward sloping, because that tells you the marketplace is thinking generally positive future. Money rates will be a little bit higher the further out in time you go, which is what you would expect to happen in the financial system. And if rates are nominally at a relatively decent level, historic level, with an upward sloping curve, you think, okay, everything's good. That's the marketplace saying, I'm happy, don't really want to own too many treasuries. They got upward sloping, which means higher rates in the future. That's the base case, ideal case. And if it doesn't look like that, then you got to figure out why that is. What is reshaping the curve or twisting and distorting it out of that ideal position? And it could be a number of different things. If we're going into an inflationary period, what you would expect to find is that the yield curve would steepen out, which is, this gets into the interest rate fallacy and what's contrary to most people's perceptions, because what they're taught is that higher rates are restriction and therefore that's anti-inflation, and lower rates are stimulus and therefore that's, likely inflationary, because you hear it all the time. The Fed lower rates, that's going to be inflationary. That's exactly the opposite.
Okay, I bang that drum hard. So this is one of the reasons that you're so interesting to me. I want to understand what's true. So walk me through, as somebody who I look at the deficit spending and I go, we're going to be money printing, because that money has to come from somewhere. And so now we're assuming we can't just sell all the debt that we want to sell. The Fed's going to have to step in. The Fed's going to have to swallow up some of that. The Fed's going to lower rates, stimulate the economy, get the cheap money flowing so that people can keep everything moving. So when I look at that, the story seems right. You get cheap, easy money into the economy, it's going to be inflationary. So what am I getting wrong? Is there something else that's really driving it, or what?
Historically speaking, during depressionary periods, interest rates are low, and interest rates that we can see are low because people want safety and liquidity. You go back to the 1930s, which is the clearest example. In the 1930s, you had too many parallels to what we're experiencing today. All the same types of stuff. You got a big crash and then a depression afterwards with lingering unemployment. Yet the government went completely insane. You had the New Deal, which a lot of people said at the time was going to lead to skyrocketing interest rates and out of control inflation. The Federal Reserve, hiked its reserve requirements in 36 and 37. So there was the same type of setup, but it never actually happened. And the reason was because the banking system had broken down so much and deflationary money became so entrenched that the banking system, financial participants, wealthy individuals wanted safety and liquidity. So no matter how irresponsible the FDR's New Deal got to be and how fiscally reckless the government became, there was no need to bail out the Treasury market because there was endless demand for safety and liquidity. And unfortunately, safety and liquidity means U.S. government debt. And other forms of sovereign debt, too. I mean, we wish that wasn't the case. And it's not really about the government so much as that, historically speaking, government debt markets are the deepest and most mature. And what really matters more so when we talk about safety is the liquidity characteristics more than, say, the credit profile of the issuer.
Okay, meaning a ton of people are buying the debt. No worries. I put some money in. I'll be able to get it back out.
Exactly. I can sell it tomorrow at a price that I'm reasonably assured that I know what it is today. And that becomes very important when you talk about treasuries and other government bonds as collateral, which is an important part of the monetary system, this Eurodollar system. But in depressionary periods, that demand for safety overwhelms every other consideration. So for the entire 2010s and into the 2020s, we've been sitting here watching the U.S. government get broker and broker and broker, stupider and stupider and stupider. And yet Despite all of the proclamations that bond vigilantism was going to come back roaring into the system, that the Fed needed to bail out the Treasury market, it never once happened. And the reason was because of depression economics. Demand for safety overrode every other consideration and continued year after year after year. So in depressionary periods, that demand for safety becomes paramount, which means that interest rates on instruments like government bonds stay lower throughout the deflationary period, which is, again, contrary to what people are taught. People are taught low rates are stimulus when, historically speaking, low rates are a sign that money is tight and the conditions are more depression than not. Japan, another perfect example throughout the 1990s and into the 2000s. Same thing. You had a depressionary case where JGB yields absolutely plunged and then stayed there for decade after decade because of the paramount demand for safety and liquidity. And then the opposite is true too. You go to the 1970s and the Great Inflation. What were interest rates doing in the Great Inflation? They were going up, because in an inflationary period, we have nominal opportunities in the real economy. The last thing you want to own is some kind of safe and liquid government bond. You're going to sell that thing and chase the nominal opportunities in the real economy. In fact, you have to, because on a real basis, the only way to generate returns that are sufficient to make a profit is to go into the real economy, to ditch your safety and find something else. So interest rates tend to rise during inflationary periods, the interest rates that we watch and we see. So that's the starting point. So you look at the yield curve that should be modestly upward sloping. If it starts to go up in the long end, that's not a sign that the world is trying to fight inflation. That's a sign that the market expects inflation to happen. Or it could be a better sign. If the nominal yields or the yield curve starts to steepen out, that could be a sign the market is thinking, hey, we did it. We finally achieved liftoff and we're into a recovery period and some legitimate economic growth. So growth expectations are rising. Because that's what a long run yield actually is. A long run yield isn't the Fed. It's growth and inflation expectations through time, with the Fed and central banks having some limited influence on the yield curve. So when we're trying to figure out what the situation might be today and therefore where the system is going tomorrow, you start with something like the yield curve and see what the shape is and how it's changing, because the shape and the changes in shape actually give you a clue what the market is thinking about probabilities of how things will evolve through time.
Now, are you saying that the real vibe of the economy right now is depressionary, that people are in a pure fear mode?
It's not an either or. There's always gradation and shades of gray here. So yes, what we're saying is that the yield curve, which is historically, it's still at a relatively low nominal level, which I know people don't. It's higher than it was than in 2010s, but when you line it up, a chart that shows history, rates are still pretty low. And when you have a yield curve that has been flattening out at a low nominal level, that tells you there's more fear, more demand for safety than there is the idea that we're going into an inflationary period with exceptional economic growth opportunities. So a low flat curve is a sign that there is a persistent bid for safety, which again explains why, despite all of the inflationary rhetoric over the 2020s, again, the government's deficits haven't mattered, even though they've gotten completely ridiculous. The demand for safety continues to be there year after year after year, which is one of the things that should grab people's attention. You should start asking yourself, if the 2020s didn't break the Treasury market for either inflation or fiscal reasons, why? What the hell must be happening? What must the bond market be seeing that continues to keep up this safety bid year after year after year?
Okay, this is so interesting. All right. It does feel like we have a tale of two economies. When you first said there are parallels to the 30s, I actually thought you misspoke, and I was about to be like, wait, do you mean the late 20s? Then as you went on, obviously, I realized you really do mean the 30s.
The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those four economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.